Most people think the stock market begins with the stock. That is the first mistake. They begin with the ticker. They begin with the chart. They begin with whether the line is going up. They begin with whether some man on television sounds confident. They begin with whether the stock feels expensive, cheap, hot, hated, loved, or late. I have never thought that was the right beginning. The right beginning is the company. Not the symbol, not the app, not the market excitement around it. The company, once you understand what a company actually is, the rest of the stock market becomes much less mysterious. The public likes to think finance is difficult because it uses difficult words. Very often it is difficult only because people insist on learning the outer shell before they learn the inner structure. So forget stock prices for a moment, forget financial television, forget social media, forget the language people use when they are trying to sound sophisticated. A company is, at its core, a collection of valuable things arranged in one place under one legal roof. Some of those things you can touch: buildings, warehouses, trucks, computers, machines, inventory, land tables, forklifts, cables, property, the obvious stuff. Some of those things you cannot touch at all, yet they may be worth much more than the physical things. A brand name, a reputation, a customer relationship, a distribution network, a habit in the mind of the buyer, a piece of software, a patent, a system, a cultural position inside a market. That is what people miss. They think a company is mostly the stuff you can walk through. Very often the most valuable part is the invisible force that makes the customer choose it again. If you walk through an Apple warehouse, you will see physical products, phones, laptops, boxes, components, metal and glass, and batteries and logistics. But the true power is not the warehouse. The true power is that millions of people will pay more for a product because of what the name means to them. That name lives nowhere you can hold in your hand. Still, it is worth a fortune. That is why I tell people a company is really a basket full of valuable things, some of them hard and visible, some of them soft and invisible. Once you see the company that way, the next question becomes obvious. Who owns the basket? And who gets paid when the basket produces money? That is where the real lesson begins. Imagine you are a carpenter, you have skill, you have discipline, you know how to work, you know how to find customers, you know how to turn raw material into something useful. But skill and discipline do not automatically create capital. You have saved $10,000. That's good. It's also not enough to build the operation you really want. You need a truck. You need tools. You may need a helper. You may need a little room to survive the early months. So you go to your friend Jake. Jake has money. You have skill. That is already one of the oldest financial arrangements on earth. Jake says, I will give you $10,000, but I want it back in a year with 5% interest. Fine, now you have $20,000 total. You buy the truck, you buy the tools, you start taking jobs, you build decks, you fix fences, you remodel kitchens, you patch roofs. You install cabinets. 1 year passes, the work went well, the customers paid, the truck still exists, the tools still exist. And after all your costs, you have $50,000 in profit. Now the question is not whether the business worked. The question is how the rewards get divided. Most people should understand this because it explains nearly all of modern finance. Jake is not your partner. Jake is your lender. That means his upside is capped. He gets his $10,000 back. He gets his 5%. That is it. He does not suddenly get to claim half the truck, half the tools, half the business, and half the future. He accepted lower risk and lower upside. You accepted higher risk and higher upside. That is the bargain. If the year goes well, Jake gets what was promised and no more. You keep what is left. Now let us imagine the other version. The year goes badly. The economy weakens. Customers disappear. The truck breaks. A big job goes bad. Collections come in slowly. And at the end of the year, there is no profit at all. Maybe there is barely enough value left in the truck and tools to recover anything. Jake still expects payment. That is what debt means. The lender stands closer to safety than the owner does. If assets must be sold, the lender gets paid before the owner gets anything. That is the whole hierarchy. The man who lends money is owed a fixed claim. The man who owns the business gets whatever is left. After fixed claims are satisfied, this is why I say bonds and stocks are not mysterious. A bond is simply a loan with terms. A stock is ownership with no guaranteed return. Jake, in this story, is what the financial world calls a bondholder. You are the stockholder. He bought a promise. You bought the uncertainty and the possibility. He gets paid first but cannot get rich from your success. You get paid last. But if the business thrives, the upside can be enormous. That simple difference explains more of the financial world than people realize. Bondholders stand higher in the structure and accept less glory. Stockholders stand lower in the structure and take the full emotional ride. Now let us take the story one step further, because this is where a private business begins, turning into a public market story. Suppose your carpentry business keeps working. The first year was good. The second year is even better. The third year is excellent. Customers recommend you. The phone rings. You hire a crew. Then another. You are booked months out. At some point, growth becomes a new problem. And growth problems are much better than survival problems, but they still need money. You want more trucks, more crews, more tools, perhaps a shop, perhaps entry into nearby cities, perhaps a sales team, perhaps a scheduler, office staff, and better systems. That expansion requires capital. You could borrow more. That is one path. But debt has a limit. If you borrow too much, the fixed obligations begin crowding the life out of the business. So you consider something else. Instead of borrowing all the money, you can sell pieces of the basket. That is a very important idea. You are no longer asking someone to lend into the business. You are asking someone to buy ownership in it. Maria buys a small piece. Tom buys another. Then perhaps a larger group of investors buys the rest of what you are offering. The money comes into the company. The company uses it to expand. That first moment when the business sells pieces of itself to outside owners is what the financial world calls an initial public offering. An IPO, the phrase sounds grand. The logic is simple. The company sells slices of the basket to raise money for growth. Once that happens, something important changes. The company received money at the initial sale. But after that, the shares begin moving between investors. Suppose Maria owns shares and wants out a year later. She sells them to someone else. That buyer pays Maria. Not the company, not you, not the employees. Maria. This is one of the most misunderstood parts of the stock market. People think every time a stock changes hands, the company gets the money. Usually it does not. Usually the company got paid once, at the offering or in a later direct issuance, and after that the market is simply people trading ownership claims with one another. I often compare it to a car. Toyota gets paid when the car is sold new. 5 years later, if that car is sold again, Toyota does not receive another check. The second buyer pays the first owner. The product stays the same. Ownership changes. Stocks are like that after the initial offering. The company is the company. The shares circulate among owners. That is what the stock market is. Not some mystical casino detached from reality. A market where pieces of businesses are bought and sold between people with different opinions about the future. Now, why would anyone want to own these pieces once the company itself is no longer receiving the money? 2 reasons. The first is obvious. The piece may become more valuable. If you buy ownership at one price and later sell it at a higher price, you make money. That is not unique to stocks. It is simply ownership appreciation. The second reason is even more important because it is what separates true business ownership from pure speculation. Sometimes the company takes part of its profit and pays it directly to the owners. That is called a dividend. If you own 100 shares and the company pays $2 per share, you receive $200. Nobody had to buy your shares from you. You were paid for being an owner. This is one reason I have always loved strong businesses that return cash sensibly. They remind people what ownership is supposed to feel like. You own part of the basket. The basket produces cash. Some of that cash comes to you. Simple. Now, not every company pays dividends. Many do not. Some reinvest everything. That does not make them bad. A company like Amazon, especially through much of its history, has preferred to reinvest rather than distribute. It keeps the cash because it believes the best use of that cash is more growth inside the machine. Other companies, like Coca-Cola, have long histories of paying shareholders regularly. Different businesses make different choices. As an owner, you can profit from capital appreciation, from dividends, or from both. But whatever style the company follows, the market keeps asking one question: what is this piece worth now? That brings us to price. And price is where most people begin too early and understand too little. Stock prices do not move because heaven sends signals. They move because buyers and sellers meet at different levels of confidence. If more people want to buy than sell, price rises. If more people want to sell than buy, price falls. That is the surface. But what sits underneath that surface is always a bet on the future. A price is not just a number. It is an argument about what the future cash flows of the basket might justify. Apple launches something the market loves. People imagine stronger future profits. They buy, the price rises. A company reports weak earnings. People imagine weaker future profits. They sell. The price falls. Sometimes that reaction is sober. Sometimes it is hysterical. Sometimes it is intelligent. Sometimes it is emotional. Sometimes millions of people become afraid together. Sometimes millions become greedy together. The stock market is not a calculator alone. It is a voting machine filled with people trying to estimate the future and constantly revealing their own feelings about uncertainty. That is why the market can become absurd in the short term while still being useful in the long term. The emotions are real. The ownership claims are real too. And if you stay in the market long enough, you learn that the two are forever mixing. Now let me say something important. A stock is worth what people are willing to pay for it today. That is true, but that does not mean today. S-crowd is always wise. It only means today. S-crowd sets today. S-price, one of the great financial disciplines, is learning the difference between price and value. Price is what the market says at this moment. Value is what the basket is likely to produce over time. Those two things can drift apart, sometimes by a little, sometimes by a lot. That is what creates opportunity. But it is also what creates danger for the person who thinks every rising price is proof of wisdom and every falling price is proof of error. This is why I've spent my whole life trying to train people away from charts first and toward businesses first. If you do not know what the basket contains, the line on the screen will bully you emotionally. If you know the basket, well, the line on the screen becomes information rather than command. Now let us come to the most useful practical question. What should an ordinary person do with all this? That is where the world becomes strangely cruel, because the right answer is not the answer most people want to hear. Most people want the special stock, the hidden winner, the overlooked rocket, the thing they can mention later and say, I knew it. I have no interest in that game for the ordinary person. The source text you gave me ends in exactly the right place. It says that most people should not try to pick individual stocks and should not try to time the market. It says most professionals fail to beat the market consistently, and that the more sensible path is broad ownership through an index fund. Specifically, it points to funds tracking the S&P 500, the 500 largest U.S. companies, and says that historically the market has delivered about 10% annual average returns over very long periods, even though year-to-year results vary wildly. That is the adult answer. And yes, it is boring. It is supposed to be. A good financial plan should not need to entertain you. It should need to work. An index fund is simply another basket, but now, instead of owning one company basket, you own tiny slices of hundreds of large company baskets at once. Apple, Microsoft, Amazon, Google, Berkshire, J.P. Morgan, Costco, Walmart, and many more. You are no longer trying to prove that you can predict which one wins next quarter. You are accepting a humbler and, for most people, much more profitable truth. The American economy and productive business more broadly tends to create wealth over long stretches. Instead of trying to be the hero who picks the one perfect name, you own the machine. That is the better game. If one company stumbles, others keep going. If one industry weakens, another may strengthen. You lower your dependence on being individually brilliant. That is a wonderful thing to lower. I think a lot of people ruin themselves financially because they are too attached to the fantasy of brilliance. They want to feel above average more than they want to become wealthy. Those are not the same ambition. To own a broad index fund and keep buying it quietly is not a glamorous act. Nobody at a party will be impressed. Nobody will call you a genius. Nobody will think you discovered hidden treasure. Good, you are not trying to impress a party. You are trying to become financially durable. Durability matters more than style. Now, when people hear the historical average return number, they often make one of two mistakes. The first mistake is to think 10% means 10% every year. Of course not. Markets are much messier than that. Some years you will get crushed. Some years you will feel brilliant for no good reason. Some years nothing interesting happens. The second mistake is even worse. They think because the long-term average is strong, they can ignore the emotional reality of living through the short term. That is foolish too. Index investing is simple. It is not emotionally effortless. The public hears buy the market and hold, and it imagines a gentle line drifting upward with modest serenity. That is not the experience. The experience is that every few years the world seems to be ending, and your account reminds you that ownership claims can become very unpopular very quickly. This is where patience stops being a nice word and becomes a real skill. The ordinary person does not become rich from the index because he found the formula. He becomes rich because he kept obeying the formula while his emotions kept trying to fire him from it. That is the true difficulty, not access discipline. This is why I always say that the ordinary investor should care less about predicting the next move and more about designing a system he can obey. Automatic contributions, low cost, broad ownership, long time horizon, minimal drama. If you build it that way, you reduce the number of times you must be brave. That matters because bravery is not a reliable monthly process. Systems are. Now let me say something about boredom. Boredom is one of the greatest hidden advantages in all of investing. The market keeps offering exciting alternatives, a hot stock, a market panic, a new forecast, a new genius, a new reason why this time is different. The investor who needs stimulation will keep paying for that need with performance. The investor who can tolerate boredom long enough to let compounding do its slow work is already standing in a much better place. This is one reason I have always thought investing success belongs less to the clever than to the stable. The stable person can sit. The unstable person must act. The market extracts a toll from that restlessness again and again. So yes, I believe the simple answer is often the right one. Understand what a company is, understand what ownership is, understand what a bondholder is and what a stockholder is, understand what an IPO is and what the secondary market is, understand why prices move and why that movement is partly rational and partly emotional. Then admit, with enough humility to protect yourself, that the best path for most people is not prediction. It is participation in productive enterprise through broad low-cost ownership. That is not a thrilling answer. It is one of the strongest answers the financial world has ever produced. If I had to compress this whole lesson into one sentence, I would say it this way. The stock market becomes much less confusing once you stop treating stocks like lottery tickets and start treating them as ownership claims on baskets of valuable things. That is the mental shift from symbols to businesses, from charts to cash flows, from noise to ownership, from speculation to participation. And once you make that shift, an even more important one becomes possible. You stop asking the market to entertain you, you ask it to serve you. Those are very different relationships. The entertained investor checks prices because he wants to feel something. The served investor buys ownership because he wants to build something. One of those men will always have more stories. The other will usually end up with more wealth. There is one final thing worth saying, because this is where many intelligent people still get themselves into trouble. They learn the mechanics, they understand the basket, they understand bonds and stocks, they understand IPOs and secondary markets, they understand dividends and capital gains. Then just when they are close to wisdom, their ego interferes. They say, fine, I understand all that, but surely I can still outsmart the simple path. Surely I can pick the few special names. Surely I can jump in and out a little more intelligently than the crowd. Surely I can have the broad market answer as a backup while still proving I am better than average with part of the portfolio. Now, some people can, a few can. The problem is not that it is impossible. The problem is that most people do not know which kind of person they are until after the tuition has been paid, and the tuition is often expensive. The source text is harsh but correct here. It says most professionals fail to beat the market consistently, which means the ordinary person should be very careful before assuming he can do casually what full-time experts usually fail to do reliably. That is a useful humiliation. Humility protects capital, vanity endangers it. If you can remember that, you already hold an advantage many investors never gain. So when you open the app and see a sea of moving prices, do not begin with the motion, begin with the basket. Ask what the company is, ask who owns the basket, ask who gets paid first and who gets what remains. Ask whether you are buying from the company or from another investor. Ask how you might profit and what risks you are really taking. And then, after all of that, ask the most important question of all, do I need to be clever here or do I need to be consistent? Most people know the answer to that the moment they are honest enough to ask it. And that honesty, more than any stock tip, is what builds the kind of wealth that survives your own emotions.